Hey everyone, Couch Investor back on our video for today. So as 2023 is nearing its end, we are welcoming 2024 pretty soon. And so the videos of best stocks to buy in 2024 are going to come out each and every day. Now in this video, I want to talk about three companies that I personally do not own in my portfolio. So I'm giving here my unbiased opinion on these companies. These are companies that we have covered on the channel. There will be a second video talking about my personal picks, my personal winners that I'm betting on for 2024. That video will probably come out towards the weekend, depending on when you're watching this video, of course. Now, 2023 has been an excellent year for tech stocks, growth stocks, those stocks that have been hit quite hard in 2022 because of fears of, well, the growth rates, the multiples are not justified because the economy is bad, macro environment, geopolitical issues, stuff like that. The consumer is pretty weak. Well, what has this year shown us? It has shown us the exact opposite. Now mix that with inflation has peaked, interest rates have peaked. We're going to get rate cuts already in the first half of 2024. Mix all of that together and you're getting what we're having right now, a huge rally at the end of the year as well. Which also means that you might be a bit less comfortable right now buying stocks because everything is green day after day, week after week, and that's completely normal. Like I said in plenty of videos, I prefer to buy when things are red rather than buy when things are green, and especially when things have gone up 50, maybe even 100% in the last couple of weeks. Now, this is just a list of three companies. There's plenty of other great companies to pick for 2024 and onwards, because we're not just investing for a year, we're investing for years and years ahead. Do share your picks down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, would really appreciate that. We had a tremendous year on the channel, so thank you everyone that has been supporting this channel, and thank you to all the members as well. I really appreciate that. If you want to support me even further, do check out the link down in the description and the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So company number one I want to cover is one of the biggest companies on the planet, so you might be okay, pretty lame, but hey, these companies have done pretty well this year as well, and that's Alphabet. Alphabet is up close to 55% year to date. Of course, I think a year ago, Alphabet had that $100 billion mistake, right? I called it the opportunity of a lifetime. It has done pretty well until now. Now, what has happened more recently? Well, more recently, we had another, let's call it fiasco, right? They had the Gemini presentation, the AI, and apparently, well, not apparently, it has been proven to be faked, let's call it. Google themselves admits it faked Gemini AI demo. The voice interaction never happened and the AI was not interacting in real time. But unlike last time, the stock did not really crash that much. Also, there was the Epic Games/Google lawsuit that was won by Epic Games. The stock market didn't really care much about that either. Google is going to appeal that decision as well. So it remains to be seen what happens there. But the sentiment here around Alphabet, around Google, has definitely changed. If everything that happened in the last couple of weeks happened a year ago, we would definitely see another $100 billion crash. So currently the state of Alphabet here, market cap $1.71 trillion, forward PE of 21.3 times. And if you compare it with 5-year mean here, it is a bit lower compared to its 24.7 times. EV to EBITDA 12 times compared to 13. Price to sales 5.2 compared to 5.3, so here we're a bit closer, but price to free cash flow is lower at 22.1 times compared to 28.5 times. Now, with Google Alphabet generating billions and billions in free cash flow, you know what that means. It means your shares become more valuable by the year. As you can clearly see here, for the last couple of years, Alphabet have been buying billions of dollars worth of their own shares. The result of that, free cash flow per share has increased for the last couple of years. And then we're having here a look at EPS estimates. The 5-year growth rate sits at 16.72. Now, I just want to compare this to the other big companies out there. So I compare it to Apple and Microsoft. You can clearly see that right now, Alphabet is much cheaper than both of those companies. And it's also expected to grow faster than those companies. So the analyst estimates here for fiscal year 23, 24, and 25. EPS growth for 23, 26.5%, 24, 16%, and then another 16.6% in fiscal year 2025. Sales growth year over year in 2023, fiscal year 2023, 8%. Accelerated growth in 2024, 11.2%, and then another 11% in fiscal year 2025. So we're buying here a giant company, a company with a big moat that is trading at a cheaper valuation than other huge companies, Apple and Microsoft, while they are expected to grow faster than Microsoft and Apple. So yes, some might say you might be getting a bargain here, still, even if it's up over 50% year to date. Now, of course, we know where the money is coming from, right? The biggest chunk of their revenue is Google advertising. The biggest chunk of their operating income is Google services as well. But with Google Cloud still growing quite fast, although last quarter, yes, growth wasn't as high as expected, which is also why the stock was hit a little bit after they reported earnings. It is becoming a bit more profitable for them as well. Still nowhere near close to AWS or Microsoft Azure, but don't sleep on Google Cloud. YouTube will still continue to grow as well. And then, if you look at how much free cash flow they generate in a quarter, $22.6 billion, this company is a cash flow generating machine. And yes, you already know what I'm going to say. Don't sleep on the rise in popularity of the Pixel phone. So with Alphabet, you're buying a pretty big company, but as we've seen in 2023, even the biggest companies on the planet can still outperform the market. And if we are going into maybe a small recession period, you would rather have a pretty strong free cash flow generating company that is still growing at a okay price than another speculative play, in my opinion. Up next, company number 2 is a company that, of course, a lot of you know, a lot of you think this is controversial to talk about. I've talked about that in the past, so I have to put it in the list as well, because my last video on that company was whether or not this company can 2x in 2024, and that's the Chinese company, that's Alibaba. Now, of course, with Alibaba, you pretty much know that if we look at the valuation metrics, it's going to be extremely cheap, extremely low compared to its 5-year mean, whether it's PE, EV to EBITDA, price to sales, price to free cash flow, all of that is well below its 5-year mean. The stock price as well, at $75, market cap of $191 billion. Year to date, it's down 13.25%. If you look at the 5-year chart for this stock, you can clearly see that it has underperformed by quite a lot, whether it's pandemic, shutdowns, economic slowdown in China, turmoil inside the company, spin-offs, no spin-off, new CEO, ex-CEO coming back, you name it, there's been a lot of controversy and a lot of, negativity around the company like Alibaba, plus mix that with a huge competitor right now, Pinduoduo, the company that also owns Temu, is definitely taking some market share. But as we've seen in the last video, Pinduoduo currently is valued at more than Alibaba, despite generating less operating income, less revenue than Alibaba. So it's not about, nobody wants to invest in Chinese companies. No, because Pinduoduo was actually up or is up over 75% year to date. So I would say, I think there is value here with Alibaba. Of course, you have to invest in it and know that there is a lot of baggage attached to that as well. Now, the growth rates here for the next couple of years, we can clearly see that the bottom line is accelerating, is growing faster than the top line. For fiscal year 2024, we're seeing 14.5% growth in EPS compared to 5.9% sales growth. But in 2025, it's basically the same for both. So 9% sales growth, 9% EPS. 2026, another reacceleration in EPS, close to 12% growth, and then close to 9% sales growth. And with Alibaba as well, because it is regenerating right now more and more free cash flow. Of course, 2022 was not a good year for the company, but 2023, it came back to its free cash flow machine days. It can buy back more shares. And here as well, you can see the EPS growth rates, 17.45%. So even stronger than Alphabet. Now, in this case, I do want to show you what analysts are expecting, what Wall Street is expecting. Well, the average price target sits at $126, which represents a 67.2% upside in the next 12 months. If we go back to the latest earnings report here, free cash flow for the quarter was $6.1 billion. If we look at the overall business, the different segments as well, whether it's revenue or adjusted EBITDA, all of them are increasing year over year. Of course, the cloud segment only increased 2% in sales, which isn't that much. But if you look at the adjusted EBITDA difference year over year, it's a difference of 44%. Most of them are up double digits and even more than 20 to 40% as well. So you're definitely seeing some improvements at the top, but definitely at the bottom line for Alibaba right now. So there will come a time where the market will just look at it and say, look, we're just leaving money on the table here. Let's go with it, invest, because it is extremely undervalued. If this was, I know this is always the same thing. If Alibaba was a US company, this thing would be worth close to $1 trillion by now. But of course, it isn't. So you have to attach a little bit of risk of that. If you have a margin of safety that you put on every other stock, whether it's 15%, 20%, then of course, put a higher number on Alibaba, but you will still get to the conclusion that it is still extremely undervalued. And so I had to put it in that list. Up next, company number 3 is a company I wish I had bought when I was extremely bullish on that, but unfortunately did not have the cash, had too many positions anyways, and that's one of my favorite companies that I do not own, and that's Netflix. I know, another pretty boring name, but a pretty strong company to own nonetheless. Netflix currently is trading at 32.9 times forward PE, has a market cap of $216.6 billion. Year to date, it's up 67.87%. Last year, after everybody thought in February of last year that Netflix was dead because it missed one quarter in the subscriber estimates, it was down 2 million or something like that. The stock just got crushed. But like we've seen with Meta, with Netflix, with Nvidia, stuff like that, it's always the noisiest at the bottom or close to the bottom. And so what can we see here? Well, right now, PE compared to its 5-year mean, still much lower, 32.9 times. That's because the company is becoming more and more profitable. See the same here with EV to EBITDA. Price to sales is a bit closer, but price to free cash flow, this is exactly what I've been talking about. Free cash flow is getting better and better here. We're now trading at 38.2 times compared to 130.4 times. And this also means that after years and years of shares outstanding increasing, we're now seeing a share buyback program. We're now seeing free cash flow become positive, and we are seeing here EPS growth rates that we have not seen in any other company covered in this video, close to 24% in the 5-year. Now, what are the analysts expecting for the next couple of years? Well, here the same thing, the bottom line to increase much faster than the top line. You can see here fiscal year 2023, EPS growth close to 23%, fiscal year 2024, 30%, fiscal year 2025, 22.8%. For the sales growth, we're sitting at 6.3% for fiscal year 2023, 13.7% in 2024, and another 11% year-over-year growth in fiscal year 2025. Now, with Netflix, we're obviously talking about a lot of competition in the streaming market, right? Well, I want to show you this picture right here. Streaming cancellations jump. Where does it not jump, really? Well, this guy right here, Netflix. Here, this is a picture that can say way more than an article, than a little video. This really shows the power of Netflix. I'm not going to stop there. Netflix will surpass Disney Plus US ad revenue next year. As more and more people switch to the ad-supported tier, more advertisers will flock to Netflix because they see, look, they've got the content, they've got the subscriber base, so our ROI will probably be higher with them than with other competitors. And of course, as more and more content moves from linear to streaming, more advertising dollars will move from linear to streaming as well. So what will happen? Increase in revenue, increase in margin as well, increase in free cash flow. They already announced last quarter that they now expect fiscal year 2023 free cash flow of around $6.5 billion, up from the prior forecast of at least $5 billion. They've also repurchased $2.5 billion of shares in Q3 and increased the buyback authorization by $10 billion. Here, if we scroll down, we can clearly see that free cash flow has been improving each and every quarter. I'm not done yet. The competitors are also realizing that they're playing here with the king of streaming, and so we have headlines like this. In search of cash, studios sent old shows back to Netflix. When building their own streaming companies, many entertainment studios ended lucrative licensing deals with Netflix, but they missed the money too much. For example, Grey's Anatomy all seasons to stream on Hulu, Disney Plus combined app. Disney prepared to license 14 shows to Netflix. Of course, they're not going to license shows like Marvel releases, stuff like that. Same with HBO. I don't think we're going to see Game of Thrones on Netflix. But other shows, yes, are going to be licensed to Netflix. They're going to make money. Netflix is going to make money. Everybody's going to be happy. But it has become extremely clear here. The streaming wars has been won by Netflix. So that will be it for this video. These are the three companies. These are the three picks. I don't own those companies, but these companies will do, in my opinion, quite well in 2024 and onwards. If you agree or disagree, let me know down in the comments below. Which are your picks? Let me know as well in the comments below. And remember, I will make a separate video of my personal picks from my portfolio that I think will perform extremely well in 2024 in the next video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.